Hi, good afternoon, Mr. Kutty. Very quickly, I want to first understand from you first off, thank you so much, Mika, for handing that over. But Mr. Kutty, first off, pleasure speaking. Good afternoon. I want to first talk about the key number here, margins. They've come off substantially when I'm looking at it year over year. What should we expect as part of this rate cut cycle? Currently, you're able to hold them, at least in Q4. But can we expect margin dilution further, maybe over the next quarter or two? And if so, how much and whether it will be temporary?
Good afternoon. Thank you for having me here. It's always a pleasure to be with you.
Thank you.
The numbers are decent. We quite like. It's in line with what we had planned out in our business strategy. The top line growth is 22% for the year. What's even more heartening is the operating income is moving in line with the top line. We're very happy with the increasing jaws. Our income growth as a percentage is higher than the cost growth. And the portfolio quality is looking better. The gross NPA, the lowest in the last 5 years, below 3%. Slippages have come down. Our provision cost, if you were to look at it and compare with the operating profit, we got a 5 times cushion. So all in all, a decent year. As far as the NIM is concerned, your specific question, yes, the NIM is stabilized. We've been able to manage the rate cuts so far by a combination of two activities. First, we'll talk about the liability side. We have gone ahead and reduced the savings account rate, which has an immediate impact on the net interest income. And also, we have done some tweaking on the retail term deposit, both bulk as well as retail. So that will have a long-term impact. You'll see the entire benefit of that coming over the next 12 to 15 months only, progressively each month over the next 12 to 15 months. On the asset side, we've grown co-lending quite a lot last year. I don't think that we'll see similar kind of growth happening this year because while co-lending comes at a lower cost, it really reduces your net interest income. The yield that you get is lower than what you would get from organic sourcing. So that's one. The second is that you see more of business loans, which as compared to home loans, so which will get you a better yield for the similar kind of cost of funds, similar kind of cost, and similar kind of slippage in gross NPA. So these are the activities which we have done and we'll continue to focus on to ensure that the margins are protected. But it's important for me to tell you that if there are more rate cuts in the offing, and the sooner the rate cuts are coming in, we will not be able to pass that on and the margins will take a hit.
But that will be transitional.
Yes.
Okay.
Absolutely.
Okay. So they will recover thereafter. And thereafter, where do you see it settling in at the end of this cycle?
Absolutely. So the only reason is that the rate cut has got an immediate impact on the floating rate EBLR linked loans, whereas the actions that we take on the term deposits will see the effect over a 12 to 15 month time, maybe even slightly higher.
Where should it settle in at, sir? Is 3.3 the realistic number, 3.5, 3.1? Where should it settle?
Well, the work is on. We would like somewhere between a 15 to 20 bips increase on the NIM. Okay. So there's a lot of work happening on that count. But again, like I said, what we have is our controllable variables. If rate cuts were to happen in the future, we're going to deal with it at that point in time.
Point taken.
So we'll work on what we can control.
Fair. Let me talk about growth now because you've done very well this year, 25%. You're also guiding to double your balance sheet every 3 to 4 years, which is roughly 18 to 24% in terms of growth. How do you see loan mix evolve as a result of all of this? Because and ancillary to this, because your aspirational credit cost number is roughly 0.5% odd, and therefore just trying to understand how the loan mix will evolve.
So there are something sacrosanct to the bank, which will stand good in all weather. And that is that we would be a smaller ticket, granular, secured, business-oriented bank. In times of NIM compression, there is always this temptation to go to a higher yielding unsecured loan or even a high yielding secured loan. We'll ensure that the growth that we have is within the business strategy that we have kept for ourselves. That strategy is not going to change. There are headwinds in the market as far as advances are concerned. MFI has taken its share of blows. But despite that, we've seen an improvement in portfolio quality. And for us, portfolio quality improvement is absolutely cardinal. It's very, very important for us. So the growth that you would see from DCB Bank in the coming quarters and possibly even the coming years would come from similar kind of stock, which is secured, granular, retail. That's a key. And we really believe for a bank with a balance sheet size of 76,000 crores, there is enough in the market, enough good lending that is possible in the market, which falls within the framework that we have.
Okay, and how should OPEX evolve? We are currently sitting at around 60% in terms of your cost to income. You expect to taper down on that? What is the lever which will help you expand ROA from here?
Yeah, first let's talk about the expenses bit. For the first time in 4 years, we've seen the jaws expanding. The rate of increase, the percentage increase in operating income is more than the percentage increase in the operating cost, both at a quarter level, of course, and also at the yearly level. We intend to continue widening the jaws. Where is the operating cost benefit coming from? Primarily, it is coming from two sources. One is productivity improvement. 3 quarters back, when I came onto the media, and I made a commitment that I do not see the number of employees that we have increasing from the current level for the rest of the year, and also for even the next year. I stand by it. In fact, the number of employees has come down. How are we able to sustain similar growth despite the number of employees coming down? The answer is fairly simple, difficult to implement, but simple to explain and articulate. The productivity increases that we have put into place has really helped. Second is a lot of expenses have gone into technology and more will go into it. And that has started showing results in reduction of operating cost, the paper stationery cost, the courier cost. Those are the costs that which has come down dramatically. We're really playing the technology game to reduce the cost of operations, and it has got a spin-off benefit in terms of lesser operating errors and hopefully better work-life balance for our people as well.
And therefore, what's the aspirational ROA like, sir? Because you're still evolving on some of these strategies, and therefore, what would that goal be? Maybe a couple of years from now, where would that ROA number lie?
So we currently close the quarter at 0.95% ROA.
Correct.
And for the year, we closed at 0.89. The first milestone in our journey, that's not a destination, it's a milestone in our journey, is to get to 1% ROA and 14% ROE. So that's a first step. We're working on it every quarter. What we're focusing on currently is to ensure that every quarter is better than the quarter that has passed in terms of 5 parameters: growth, operating income, cost, provision, and also capital usage. All the 5 are important for us. It's easy to say it, but that's what we want to do. We are focused on it. And if you were to see the last 3 quarters, it's been kind and generous to us. We've managed to achieve this. So the whole game plan is to become consistent, predictable, and boring.
Okay, so take your point, Mr. Kutty. We'll leave it at that. Of course, we'd love to continue to talk to you every quarter to try and assess as to where we lie with regard to being consistent, predictable, and boring. But it's interesting to hear that from the leadership of a bank. So thanks so much for joining us and giving us those insights.